Good morning and welcome. Hope you guys are having a good week. Today we are going to talk about chapter 8 and probably get into chapter 9. So I'm going to share my screen. So, chapter 8. And let me get back to the beginning. Audit, audit planning and analytical procedures. In anything we do in life, for it to come out well, we have to properly plan it. Likewise, in auditing, it is important that we properly plan the audit for it to be executed efficiently. When we talk about analytical procedures, what are analytical procedures? Analytical procedures, we're looking at relationship among data. When you guys were doing accounting 102, you're talking about trend analysis, vertical analysis, and ratios. Those are all analytical procedures. So what are some of the things we're going to learn today? We're going to discuss why adequate audit planning is essential. How do we make client acceptance decision and perform the initial audit planning? We will gain an understanding of the client business and industry. How do we do that? How do we assess the client business risk? And what is client business risk? Methods of performing preliminary analytical procedures. What are the purpose of analytical procedures and when do we perform them? We'll select some of the most appropriate analytical procedure from among the 5 major types. And the last thing we'll do is compute common financial ratios. Now, in item number 8, I'm just going to talk about financial ratios. In this class, we're not getting into computation of things. You do that in your financial accounting. In accounting 102 and in your intermediate financial accounting, you did computation of financial ratios. We're not going to compute them again. We're just going to talk about them. Why adequate planning is essential. Think of this. You decide to enroll in your college to get a Bachelor of Science degree in accounting. You plan to spend 4 years or 6 years or whatever the case may be, and at the end, you like to come out with a BS degree in accounting. For that to happen, you must properly plan your stay on how much credits you're going to take each semester. If you want to spend 4 years, you must take 15 credits a semester. So 30 credits a year, 120 credits in 4 years, assuming you're not taking some classes. In addition to that, you must plan the sequence of courses that you're taking because they're the common core requirements for your major. And then there's the major requirements. Along with that, some courses have prerequisites. So you need to plan your sequence of courses that when you get to the last year, you should meet all your prerequisites and you should left with only 30 required courses. If you don't do that and you just take any courses that come to your attention, you may end up taking 150, 160 credits before you graduate. So for you to graduate in a timely manner, which in this case is 4 years, you need to properly plan each semester, which courses you're going to take, what should be the mix of core requirements and major requirements. You want to make sure that you're completing your prerequisites in your first and second years, so that in your junior and senior years, you are not prevented from taking the courses that you're required to take. Likewise, when we're performing an audit, we need to plan it. When are we going to start? When we expect to finish? How much staff we going to need? Should we need a specialist? How much man hours we going to spend on the audit? Because the man hour will determine how much you should bill the client. Most accounting firms bill on an hourly rate. Then not only how much man hour, how much junior level staff hours, how much senior level staff hours, how much manager level staff hours, how much partner hours. Because each one of these staff ranks bill at a different rate. And they also cost the firm at a different rate. It's important that we do this because an audit is labor intensive. And if the firm doesn't manage it properly, they're not going to make money on the audit. Because at the beginning of the audit, you give a client the price that you're going to charge. That price should be based on the estimated hours you expected to spend in each category of staff time. When you're conducting the audit, you want to make sure that you are spending the appropriate time and you're not exceeding your budgeted hours. If you're going to exceed your budget hours, you want to make sure that the client know if you're going to bill them extra, right? If you cannot bill them extra, then the firm is going to have to suffer that loss. Your profit will not be as big as you plan. So planning is important. The main reason for planning is to obtain sufficient appropriate evidence for the circumstances. In auditing, we are obtaining evidence, we are examining the evidence to come to a conclusion, and based on that conclusion, we are issuing our opinion on the financial statement. So we need to plan the audit that we gather sufficient evidence to give us a basis for that opinion. To help keep audit costs reasonable. Again, earlier I told you that in audit it's labor intensive and we want to make sure that we keep the labor costs within the budget. And thirdly, to avoid misunderstanding with the client. Can you guys hear me fine? Hello? Now, in anything that you're doing with another party, you want to make sure that there's a clear understanding of each person's responsibility. And this is why we get into problems, especially in our personal relationship. There's no clear understanding on who is responsible for what. Think of this. You're going out on a date with someone on Saturday night. There should be an understanding of each party on what to expect in the date for the date to go well. If I'm taking a girl out and I take her to the basketball game, which she doesn't understand at all, but which I love and enjoy, she doesn't understand it, she doesn't care for it, she's not going to have a good time. And the idea about the date is not for me to have a good time, but for us, most importantly, her to have a good time. So it's important before we go on a date that I inquire about what are some of the things she likes. And then plan the date around some of the things that we both have some common interests. Likewise, in the audit, you're not looking at things that we like, but we are looking at what does it take to get the job done? Who is responsible for what? The client, you want to outline what the responsibilities of the clients are. You want to outline what the responsibility of you, the accountant, is, or the auditor. how and when these responsibilities will be performed. Before you go to the client premise on day one, you want to have a discussion, and maybe most importantly, you want to follow up that discussion with an email or something to document your discussion in writing of what should be present when you get there. Because if you get there and the client staff is busy and they don't have nothing prepared for you, you're going to waste the day. So planning is important to keep the audit costs down. It's important to avoid misunderstanding. Because if you go to the client office and they're not prepared and you waste your day, you're going to be upset. So you want to make sure that they are prepared on day one, that they got the information that are needed for you, that the staff will be available to answer your questions, and so forth. So planning is extremely important in the audit, as in everything else that we do in our life. If you do not plan something properly, the execution cannot be efficient. Now, it doesn't mean that because we plan it well, it will be executed well. But for something to be executed well, there must be a proper plan. The main reasons for planning: accept the client and perform internal audit planning, understanding the client business and the industry. We're going to talk about this shortly. Assess client business risk. We'll talk about that shortly. Perform preliminary analytical procedures. These are the topics we're going to talk about in this chapter. These four topics we're going to discuss in chapter 8. In chapter 9, we're going to discuss set materiality and assess acceptable audit risk. In chapter 10 and 11, we'll talk about understanding internal control and assess control risk. In chapter 13, we're going to talk about developing the overall audit strategy and audit program. Now, a lot of what is talked about in chapter 13 are the last two items there. We're talking about it as we go along. In chapter 13, we'll put the whole things together. Now, most of the time, sometimes we don't get to chapter 13, and that's okay, because we had already talked about these things as we are going along. Some risk term you need to know. Acceptable audit risk. What is meant by acceptable audit risk? Acceptable audit risk is how willing the auditor to accept the fact that although they did a proper audit, although they comply with generally accepted auditing standards, there are still material errors in the financial statement, or the financial statements are materially misstated. Inherent risk. What is inherent risk? Think of this. You're leaving home to go to school. You're driving your car from home to go to school. Regardless of what you do, there's a likelihood, there's a small chance. When we talk about risk, we talk about chances. We talk about risk, we talk about the likelihood of something occurring. There's a small chance of you involving in an accident. That chance can increase or decrease depending on your driving style, depending on weather conditions. But on any given day, when you stepped out of your home, before you get to school, you end up in an accident. That is the inherent risk. The risk that is present in the financial statement before taking into consideration internal control, or the risk of doing an audit before taking into consideration of internal control. That's the inherent risk. In anything we do in life, there is a risk. Now, that risk can be greater or it can be smaller. Today, we are talking about COVID-19. What are the risks? of us being exposed to COVID-19. Well, we can, it would not be zero, but it would be some number. Now, if I go out without a mask and I go to all these bars and having drinks and conversation with people, the chances of me getting COVID-19 is much greater. On the other hand, if I take precaution and I use a mask, I wash my hands, I go to places where they have good precautions, then my chances of getting COVID-19 are lower. Last weekend, I was at the Hard Rock Casino. Before you enter the casino, before anyone enter, the Hard Rock Casino is in South Florida, in Miami, Hollywood. They test your temperature. They make sure you do not have COVID-19. While you're in there and you're gambling or whatever you're doing, you have to get your mask on. Whether you're in the hotel, whether you're in the restaurant, you have to get your mask on. When you're gambling at the tables, they will clean it before and after. If you're gambling at a table and you're sitting here, before you sit, they will clean the table. They'll sterilize it. After you left, they sterilize it before the new person comes on. While you're playing, you will sanitize your hands. All of these are measures to decrease the risk of you getting COVID-19. So there are inherent risks, but that inherent risk you could reduce or decrease depending on how you act accordingly. If you're driving to school, you could increase that risk of getting into an accident if it's snowing that day, if you're driving speed, if you're boring a stoplight and not observing the traffic signals, then your chance of getting into an accident is higher. On the other hand, if you drive within the speed limit, you observe the traffic signal, you're assertive, you're aware, it's a nice sunny day, your chances of getting into an accident is much lower. So we talk about inherent risk. We talk about the risk that you get into an accident before considering all these things, before considering the weather condition, your driving style, and all of that. Make client acceptance decision and perform initial audit planning. Now, when we go through the section, it's going to sound like steps that you do. But in practice, you do not do one then move to the other. Sometimes you do them simultaneously. Client called you, they want an audit. You're going to start right on the phone making that decision. Well, why you need the audit? What kind of company you have? What industry you're in? You start to interview the client. At the end of the process, you'll make a decision. Is this an audit I could do? Or this an audit I cannot do? Or maybe this is an audit that I don't want to do, right? If you're a small practitioner, a lot of times you get a call from a client and it's something you never did before. Does it mean that you don't take the job? No. You have three courses of action. One, you could take the job and make sure that you read the literature and get the competency, which is what most professionals do. Two, you could decline the job. Or three, you could refer them to someone else who do that type of work. Initial audit planning, client acceptance and continuation. Should I accept this new client? Should I continue the new client? What are some of the things you look at in accepting a new client? Well, you look at the client's integrity. Are they ethical? Will they fit in? Is it the job that you have experience doing? Or do you have to do substantial work before doing the client work? Identify the client reason for the audit. Do they need it because they're doing some filing like SBA filing or minority business and so on, and they need the financial statement to get certified? Or do they need it because they're getting a loan? What's the risk associated with what they're doing? If the company going public, they're raising a lot of money. So if something goes wrong, your exposure is much more. Also, if they're going public, you must be a member of the SEC practice section. And you must be competent in doing public crime. Years ago, I used to do public audits for public companies. I used to be a consultant in Wall Street doing public companies audit and running audits for other CPAs. Now I don't do that anymore. Why? Because the risk, if something goes wrong, you're exposed. Somebody's suing you for millions, if not billions of dollars, right? So these are decisions you have to make. Obtain an understanding with the client, what you're going to do, what they should expect, how much it may cost. And then you develop the overall audit strategy. Now, when you obtain an understanding with the client, you want to document that understanding in the form of what is called an engagement letter. The engagement letter outlines the terms of your agreement with the client. When the audit will start, when to expect to finish, how you're going to charge your fees, when they expect to pay you. Important that you do that. New client investigation. A new client calls you. If they had an audit done before, you're required to communicate with the predecessor auditor, the prior auditor. The client has to give the prior auditor permission to respond. Sometimes students ask, well, what if the client doesn't give the auditor permission to respond? Well, you want to think hard and strong. Do you want to take on this client? Why they don't want the prior accountant to respond? What are they hiding? The client that you have dealt with before, should you continue to service them? Well, what's your experience been? If your experience has been a productive one with the client, you want to continue to service them. If the client is a pain in the rear, you may not want to. Now, with new clients, when you communicate with the predecessor auditors, you're going to ask them certain questions. Are there any disagreements with the client in regards to gap? What was their experience working with the client? Does the client pay their fees on time? Right. These are important questions. Think of this. You have a date with a girl who is a friend of one of your other friends. You may want to call your friends up. Hey, how is this person like? What does she like? What she doesn't like? Or you may just ask them up straight up. What are some of the things you like to do on Saturday night? You want to go to the movies? You want to go to a party? You want to sit home and watch a movie? Identify the client reason for the audit. Two major factors affecting acceptable risk. Likely statement users. Who are going to use the statement? And I give you two examples before. If the client is getting into a minority business certification, your exposure is not that great. On the other hand, if the client is going public, your exposure becomes tremendous because they're raising millions of dollars. Intended user of the statement. If it's going public, you don't know who's going to use it. Any potential stockholder will use the statement. You're likely to accumulate more evidence for companies that are publicly held, have extreme indebtedness, likely to be sold. If the owners are looking to sell the company, they may want to paint a nice, good picture that they're making a lot of money when they probably aren't. Updating understanding with the client. The engagement terms should be understood between the CPA and the client. Standard require an engagement letter describing the objectives, the responsibility of the auditors and management, and schedules and fees. And a sample of the engagement letter is in your textbook. Please look through it, read through it. You want to inform client that audit cannot guarantee all acts of fraud will be discovered. This is a major misunderstanding between the public and the CPA profession. Once you certify, especially dealing with small clients, Once you certify a financial statement, the public feel that, hey, everything is fine and dandy. They refer to it as the accountant blessed the financial statement. So they're putting us right next to God, where we belong, by the way. We bless the financial statement. Now, they think that once we sign off on that audit report, that nothing could go wrong. That's not the case. Because when we do an audit, we only examine a sample of that information. And based on our experience with the sample, we project what the population is. And everybody who did statistics or economics 220 know that when you do that, when you do statistical analysis, there are degrees of error. So there is a chance that we could come up with the wrong conclusion. I'm not going to get into the bell-shaped curve and all of that, but there's a likelihood that we could come to the wrong conclusion. The public are not that knowledgeable about that. They think that once we sign off on that audit, that everything is fine and dandy. Develop our overall audit strategy. Our preliminary audit strategies consider the client, business, and industry, material misstatement risk areas, number of client locations, past effectiveness of internal control. If the internal control was strong in the past, it should be strong. Preliminary strategy help auditor determine resources required and staffing. Staff continuity, need of a specialist. Think of this. If we are auditing Tiffany's jewelry, well, we have to count the inventory at the end of the year. Are we, the auditor, competent in counting the inventory? Not really, because we are accountant. We are trained in gap and guess. We're not trained in determining if this is gold or this is gold plated or gold look-alike, if this is real diamonds or not diamonds, and the value of these things. So while we are counting the inventory, we may want to coordinate that count with a specialist who is a jeweler. So when we count that we are counting the gold, the jeweler will certain that those are gold. When we're counting the diamond, the jeweler will certain that those are actually diamond we are counting and not diamond look alike. Same if we're counting computer chips. A little piece of chip may look insignificant, but if it's some new technology, it may worth millions of dollars. So we may want a computer specialist with us while we're counting. Gain an understanding of the client business and industry. We accept the client, we're going to do the audit. We need to understand their business. We need to understand their industry. So the things we're going to talk about here that we do for audit client, any major clients my firm have, we do that. We will go out, we'll meet with the client, we'll get to know their staff, we'll tour their facility, we'll see how their operation is going. Because if we understand their operation, we could make better recommendation on how they should conduct their business. And our job as the accountant is not just to do the numbers, but to help the client make their business better, help the client grow their business, help the client make their business more profitable. We look at it as a partnership with the client. If you have a small client that you're charging $1,000 a year, and you help them grow from 100,000 to 1 million, you're probably going to charge $1,000 a month, right? So not only the client is growing, your business is growing. Understanding the client, business, and industry. Client business risk. What is client business risk? Client business risk is the risk that the client will fail to meet their objectives. Generally, one of the client objectives is to maximize profit. That's their main objective of any business, to maximize profit. What are some of the things that could affect this? Declining economic conditions. You guys are seeing that right now in COVID-19. If you take some of the stores on Jamaica Avenue, they're probably seeing a decline in sales. If you go to the Applebee's in Jamaica, on Jamaica Avenue, you see that there's a decline in sales. Why? Generally, all restaurants have a decline in sales. But the Applebee on Jamaica Avenue, York is not having classes on campus. The York students and faculty normally go there and eat. So that part of the business, they're losing. Information technology. Are they incorporating the proper technology? Global operation. Are they in the United States or are they involved globally? And human capital. Human capital. The employees that they hire. When you guys graduate from York College, some of you are going to look for jobs in the big four accounting firms. And the big four accounting firms have strict mandates on what they're looking for from their accounting graduates. One will be a good GPA. So if you don't have that GPA, you may not want to apply. Does it mean that you could never work for the big four? Not really. You go to a smaller firm, you get your experience, and a year later you come back and apply to the big four. After I finished my first year of accounting on the job, several big four firms were after me because they're looking for experienced accountant. Rather than they invest in training you, you're already trained. Understand the client business and industry. You can look at the industry and the external environment, what type of business they're in, what industry they're in, what the bottom line of this industry is expected, how much profit this business generally generate, how does this industry conduct their operation. So let's take, for example, the client is in the trucking business. Well, what kind of trucking are you doing? Are you doing local trucking? Are you moving individual customers? Are you moving goods? Are you in the dump truck business? Are you in the 18-wheeler business? Right? Because each one of these are a little different. They have their own logistics. Business operation and processes. Where in that industry you're operating. Management and governance. Who are managing the business? Are it the owner managing the business, or they have a separate management from owner? Objectives and strategies. What are some of your objectives? What are the strategies incorporated? Measurements and performances. How you evaluate your performances, what net income you're looking for, how much sales you're looking for. Industry and external environment. Reasons for abstaining and understanding of the client industry and external environment. There are risks associated with specific industry, especially in this COVID-19 environment. If you're in the retail physical stores, chances are some of those businesses are going to go out. Because of COVID-19, everybody now have an Amazon Prime account and they're shopping online. Your groceries are delivered to your home. So rather than going out to the little stores to shop now, people are going to be accustomed to shopping online. And a lot of what we are learning now during COVID-19 are here to stay. Inherent risk common to all in all clients in certain industry. So if you're in the retail business right now, you have that risk. If you're in the brick and mortar, if you're in a physical building that you're selling your stuff right now, for example, if you're in the garment business and you're selling for the small store in Jamaica Avenue, you have that risk that a lot of stuff are going to be bought online. Then there may be unique accounting requirement associated with your business. As an accountant, I need to know what are the unique accounting requirements and get familiar with them. Factors the auditor should understand. What are your major sources of revenue? Who are your key customers and suppliers? How is the business financed? Information about related parties. Who are the owners or managers? Tour the plant and offices. Tour the, tour the physical facilities enable the auditor to assess asset safeguard and interpret accounting data related to asset. As you're touring the plant and facilities, you're getting to know how the operation operates. You're seeing if there are important safeguards in place. If they're not, you could recommend to the client. And you get an understanding of some of the internal controls that are in place. Identify related parties, affiliated companies, principal owners of the client, any other party with which the client deals with, or any other party who could influence contract terms are the related parties. Management and governance. Governance include the organization structure, the board activities. In larger corporations, they have a separate audit committees that act as an intermediary between the auditor and management. Government insight, you look at the corporate charters and bylaws, you'll read their code of ethics, and you look at minutes of meetings. The Sarbanes-Oxley Act, the SEC require each public company to disclose whether it has adopted a code of ethics that apply to senior management. The SEC also require companies to disclose amendment and waiver of the code of ethics. So the management has to sign off on their code of ethics if it's a public company. Client objective and strategies. Strategies are the approaches followed by the entity to achieve organizational objective. What are the approaches they're following? The auditor should understand what the client objectives are, especially in relation to financial reporting reliability, effectiveness and efficiency of operation, and compliance with laws and regulation. Management and performances. You look at your market share, the sales per employee, the unit sales growth, the website visitors, same store sales, the sales per square footage. All these are all performance measures. Assess the client business risk. What are some of the risks the business faces? What are some of the uncertainties that the business is facing? Client business risk is the risk that the client will fail to achieve its objective. What is the auditor primary concern? The auditor primary concern are material misstatement of financial statement due to client business risk. What do we mean by that? Let's say the client have an absentee management, and management is looking for net income of 20%. Well, management is not showing 20%, but they're looking at 18%. If management compensation is tied to net income, management may be likely to inflate their sales so that their net income goes up to reach the 20%. So their objectives may lead to misstatement in the financial statement. Understanding the business and industry, client business risk and risk material misstatement. Figure 8.4. We understand the client business and industry, we assess the client business risk, and we assess the risk of material misstatement. Go back to the example I gave you. Let's say the client is in the restaurant business. And they normally get 20% net income, and that's what they're expecting. Well, because of COVID-19, they may not make that 20% net income. If management performance are tied to net income, they may be willing to inflate the financials. So there may be a risk of material misstatement. Sarbanes-Oxley Act. Management must certify it has this design, disclose control, and procedure to ensure that material information of business risk is made known to them. So when management issues a financial statement, there are certain certifications that comes with it. That is one of it. Management must certify it has informed the auditor and audit committee of any significant control deficiencies. So if something goes wrong, there's recourse against management. Perform preliminary analytical procedures. Again, what are analytical procedures? Analytical procedures, we're looking at relationship among data. You have done some of that in previous accounting, whether it's accounting 102 or 101, and also again in intermediate accounting. You've done calculating financial ratios. Those are analytical procedures. You've done trend analysis. You're comparing, let's say, 2019 financials with 2018 and 2017. Those are also analytical procedures. So preliminary analytical procedures are comparisons of client ratios to industries or competitors' benchmark, provide an indication of the company performance. Preliminary tests can reveal unusual changes in ratio. A major purpose is to gain an understanding of the client business and industry. Analytical procedures by themselves do not identify errors or irregularities. However, they point you into areas where there may be areas and irregularities. You need to follow up with other auditing tests to actually determine if there are errors or irregularities. And I will explain shortly what we meant. Planning an audit and designing an audit approach. You set materiality and assess acceptable audit risk and inherent risk. You understand internal control and assess control risk. Now, audit risk we talk about, internal risk we talk about. Audit risk is the risk that although we did a proper audit and complied with GAS, the financial statement may be misstated, materially misstated. Inherent risk is, without taking into consideration internal control or anything else, there are certain risks associated with the business. What is control risk? Control risk is the risk that errors and irregularities will not be detected by the existing system of internal control. All these risks are defined again in Chapter 9. And that's why when we go through Chapter 9 today, we're not going to spend a lot of time because a lot of what is in Chapter 9 we already talked about in other places. And in Chapter 9, you're probably going to cover the first half of the chapter only. Understanding internal control and assess control risk. What is internal control? Internal control we talk about in Chapter 11 and 12. Internal control are the policies and procedures that an organization implements to safeguard their asset and ensure the reliability of financial information. We'll come back to that again in Chapter 11. Gather information to assess fraud risk. Well, what is fraud? We talked about fraud in one of the previous chapters. I can't remember if it's Chapter 4 or 5. But fraud is intentional misstatement. What are the risks of there being intentional misstatement? And we developed the overall audit strategy and audit program. State the purpose. Item 6, state the purpose of analytical procedure and the timing of each procedure. So, as I stated earlier, analytical procedures identify areas in the audit or in the client's financial statement where there may be unusualness. We have to use other audit tests to determine if something is actually going on. Analytical procedures may be performed at any of the 3 times during an engagement. It's required in the planning phase, often done during the testing phase, and required during the completion phase. Now note, it's required during the planning phase and required during the completion phase. It's not required during the testing phase, but it's often done during the testing phase. And figure 8.6 gives you a nice diagram of the timing and purpose of the analytical procedure. You need to review that. Topic 7, select the most appropriate analytical procedure from among the 5 major types. So there are 5 major types of analytical procedure. The auditor will select the most appropriate audit procedure. 1, we'll compare the client data with the industry data. The client showing 10% net income, we'll compare that with industry to see. Now, if you compare that and the industry is only giving 5% net income, you want to understand why is the client showing 8? Maybe something is wrong. Maybe nothing is wrong. Maybe they are very efficient in what they do. But we need to question that. We compare the client data with similar prior period data. We look at 2019 net financial statement, and the client is showing 50% increase in sales over 2017 and 2018. We need to understand, is that an error or why is that so? Or because they're probably implementing a new marketing plan that is working very well, but we see an area of unusualness. We need to understand why that unusualness occurred. We compare the client data with client-determined expected results. What are the client-determined expected results? The client-determined expected result is their budget. So we're comparing the action with the budget. And there are major variations. We need to understand why. We compare the client data with the auditor-determined expected results. Well, where does the auditor get their expected results from? Prior year's audit, understanding the client industry, and so on. We know what to expect from this client. Now, if the client data is way off from that, we need to understand why. Maybe it's an error, maybe it's not. 5, comparing client data with expected results using non-financial data. Think of this. We got a small hotel on Liberty Avenue. The hotel got 100 rooms. Without going to the client, I could ask them on the phone and get an estimate of what their annual revenue is. Well, this is what I'm going to ask. You got 100 rooms. What you actually charge per room per day? What's your occupancy rate? And based on that, I could figure out, I take the number of rooms by the occupancy rate, by the charge per day, multiplied by 365, and I could get the end results of what the revenue should be. Then I'll compare that revenue with the client actual revenue. If it's within range, I'm fine. It would not be exact, but it's within the range. However, if it's materially different, I need to ask some questions. And that's what we are saying with number 5. Eight, we're going to compute some common financial ratios. I'm not going to go into the actual computation. We are not going to go into computation in this course, but we're going to talk about what these ratios are. In accounting 102, and also in probably your intermediate accounting, you talk about short-term debt paying ability. You talk about liquidity activity ratios. You talk about ability to meet long-term debt obligations, and you talk about profitability ratios. Your short-term debt paying ability, you're looking at your cash ratios, your quick ratios, and your current ratios. Your liquidity ratios, you're looking at your accounts receivable turnovers, your days to collect receivable, your inventory turnover, or your days to sell inventory. If your inventory turnover ratio is too high, it could be because you have obsolete inventory. In your ability to meet long-term debt, you're looking at your debt to equity, and you're looking at your timed interest earned. In your profitability ratio, you're looking at earnings per share, you're looking at your gross profit percentage, and you're looking at your profit margin or your net income percentage. You're also looking at your return on asset and your return on common equity. And these are the profitability ratios. So this will conclude chapter 8. And to summarize the analytical procedure, we compare ratios of recorded amount to auditors' expectations. We use ratios in the planning to understand client business and industry, and we use it throughout the audit to identify possible misstatement, to reduce detailed tests, and to assess going concern issue. So this completes chapter 8. We're going to move on and spend probably 15 minutes to talk about a couple of things in chapter 9. And that's all we're going to cover in chapter 9, the things I talked about. We are not going to cover all of chapter 9. At the end of chapter homework, you have for chapter 9. But on the lab, I did not assign any homework for chapter 9. So let's look at chapter 9. What are some of the learning objectives of chapter 9? Apply the concept of materiality to the audit. Make a preliminary judgment about what amongst the considered material. Determine performance materiality during planning. Use materiality to evaluate audit findings. Define risk in auditing. And that's where we're going to probably stop. We're not going to talk about the audit risk model. Consider the impact of engagement risk on acceptable audit risk. We talk about what acceptable audit risks are. Consider the impact on several factors on the assessment of inherent risk. We talk about inherent risk in chapter 8. Discuss the relationship of risk to audit evidence. Discuss how materiality and risk are related to, integrated into the audit process. So we're not going to cover all this. We're probably going to cover the first 5 items in chapter 9. Most of that we cover in other parts of the course. Apply the concept of materiality to the audit. Materiality. Also, materiality we talked about in one of the prior chapters. And materiality is important enough to influence the user decision. It could be important enough because of its size, which is quantitative, or it could be important enough because of the circumstances under which it occurred, which is qualitative. I give you an example in my past lectures. Think of a 5-point difference in your grade. If you're getting an 89, well, a 5 point will put you to an A upwards. That's very material. On the other hand, if you're getting an 81, a 5 point will still keep you at a B. So it's not that material. So what are the major considerations in determining the appropriate audit report? Reference in auditor responsibility section of the audit report. What is meant by the term materiality? And again, materiality is important enough to influence or to affect the user decision. Auditor responsibility. What is the auditor responsibilities in regards to materiality? The auditor responsibility is to determine whether financial statements are materially misstated. Auditor will bring material misstatement to the client's attention so corrections can be made. Make a permanent judgment about what amount to consider material. You go to the client, you look at the financial statement, how much, what dollar amount you think will affect the user decision. And again, you're not going to stick to that because you're also going to look at the circumstances under which it occurred. We set preliminary judgment on materiality. The auditor will set materiality threshold early in engagement. If I'm looking at a client that got maybe $1 million of total asset, I may say that 50,000 or below may not be considered material. Does it mean that I ignore every error? No. I will keep a tab on the errors. And if they add up to less than 50,000, I will ignore them. If they add up to more than 50,000, I need to consider them. So that's what they talk about. Threshold represents the maximum amount a statement could be misstated and still not affect the user decision. So my threshold here, where I give you that example, is 50,000. If it's more up to 50,000, I will not consider them material. So I will keep a collection of my errors, and if they're not totally above 50,000, I would not. And that's the threshold I just set in my example. Somebody else may set a different threshold. He may set 40 or 60,000. Where the threshold come from? It depends on the auditor judgment. So factors affecting judgment. Materiality is a relative rather than an absolute concept. And we talked about materiality before. Right? Benchmarks are needed for evaluating materiality. In the balance sheet, we're looking at either total current assets or total asset. In the income statement, we are looking at net income. Qualitative factors also affect materiality. I give you the example with your grade. 1 point could make a difference from 89 to 90. So although 1 point may not sound that much, from 89 to 90, it is important because it changes your grade from a B to an A. When we're looking in the business environment, qualitative factor, consideration that may render material a quantitative small misstatement include if we have a loan covenant. Although it may be $10, which is not considered material, but if we fail the client to meet the loan covenant, it will be material. If it will affect management compensation, if it's changing trend, if it affects financial statement user, if it conceals an illegal act, if someone stole $100, although $100 may not be material, it now becomes an illegal act, so it now becomes material. Guidelines. Accounting and auditing standards do not provide specific materiality guidelines. So where do we get these guidelines from? It's based on professional judgment. How do we come to this professional judgment? By making judgment call over and over and over. And that's why when you graduate from college, you go work as a junior auditor so that you will learn, so that you'll make decisions. And you're probably going to make some of the wrong judgment call, but the senior is there to correct you. When you mature enough, then you're going to become a senior and you're going to be running audits where you could make the proper judgment call. Determining performance materiality during the planning stage. I'm not going to bog yourself down too much with this, but we'll run through it quickly. Evidence is accumulated by segment rather than for the financial statement as a whole. Most practitioners allocate the materiality to the balance sheet accounts. So what do we consider? We consider total misstatement in my example of 50,000, how much we'll tolerate in cash, how much in accounts receivable, etc. We segmentize it. in a way. We'll use materiality to evaluate audit findings. Known any likely misstatement. Auditor can determine the misstated amount in an account, the known misstatement. Two types of likely misstatement: judgmental differences or projection of misstatement from audit samples. Although we project the amount of misstatement, that can be wrong, or we could have poor judgment in some of these things. Define risk in auditing. What is risk? We talked about risk already. We defined risk in the past, but we're going to hit it again. When we talk about risk, we talk about uncertainty. The auditor accepts some level of uncertainty in performing the audit. In anything we do in life, risk exists. And it's difficult to measure and require careful thought in response. Some of us are risk averse. We do not take things that are risky. Others, we like risk. We calculate our risk. And based on our calculated risk, we act accordingly. The people that take risk are the ones that go into business. Because when you start a business, there's no guarantee on how much net income you'll make. But you calculate your risk and you act accordingly. If any of you gambled before, or you bet on the horse race, or you bet on a game, or you bet anybody on anything, you're calculating your risk. If I'm betting on the Breeders' Cup that just passed a couple weeks ago, I'm looking at the horses, and each horse is giving a certain risk factor in winning the race. And based on that, that's the potential payout. If I'm playing blackjack, then every blackjack player is looking at, they're hoping that when they hit, they're getting a 10, if they already got a 10, and that the dealer is getting a bad card like a 6. Proper risk response is critical to achieve a high quality audit. Risk and evidence. Auditors need to understand the client business and assess business risk. The auditor risk models help identify the potential and likelihood of misstatement. Now, most of this risk model that is discussed here, I'm not going to discuss it. I'm not going to hold you to it. But when you start doing audits and you have software that calculate all of these things, so I'm not going to cover this chapter in depth. And if we go to item number 6, describe the audit risk model and its competent. And we talk about these 4 types of risk. Client detection risk. The risk that although we did a proper audit that comply with GAS, we may not detect certain material misstatement. Inherent risk. The likelihood that the financial statement may be misstated before taking consideration internal control. Control risk. The risk that errors and irregularities will not be detected by the client's system of internal control. Acceptable audit risk. How willing are we to accept the fact that although we did a proper audit, the financial statements are still mistaken? And this is where I'm going to stop on chapter 9. Don't spend a lot of time on chapter 9 for our class, and the final exam is not highly important, but chapter 8 is highly important. Okay. And my next lecture, which will probably be on Tuesday evening with my evening class, will be on chapter 11 and 12. All right. Have a wonderful Thanksgiving, you all. and enjoy this long weekend. Your homework is due on the 30th for chapter 8 and on the 5th for chapter 9. Okay? Take care and enjoy your holiday. Have a good weekend. Bye-bye.